Welcome to the Crypto Briefing. In this analysis, we're breaking down the 21 shares market outlook for 2026. Our focus is squarely on the structural shifts that are set to define the next phase of the digital asset economy for professional investors. All right, let's dig in. The central thesis here from the 21 shares outlook is a really fundamental shift in how the crypto market is structured. We're moving beyond those speculative, retail-driven frenzies of the past. We're entering a new era. One that's really defined by serious institutional build-out and, well, maturation. So we'll begin with the report's main conclusion. The crypto market is maturing. It's growing beyond its historically volatile cycles. It seems the old rules just don't apply anymore. You know, for over a decade, this halving rhythm has basically defined the market. It was this reliable, almost clockwork-like driver of market sentiment and price action. But as Bitcoin's issuance rate now falls below that of gold, its marginal impact is, frankly, diminishing. This is the key point. Structural inflows and major macro realignments are now taking the driver's seat, replacing the halving. To put that into perspective, patient institutional capital is projected to absorb more than 6 times the amount of Bitcoin mined in 2025. That fundamentally alters the market dynamics. Now, what's really telling here is the data. I mean, look at this. It's a classic sign of a maturing asset class. Since 2024, Bitcoin's peak drawdowns haven't even gone past 30%. That is a world away from the 60% plus corrections we used to see in previous cycles. You've got volatility compressing, recoveries are getting faster. This, right here, is the new normal. Okay, next up, let's look at exactly how this build-out is happening. We'll start with the first major growth driver, the core financial plumbing that's being laid for institutions. So the first key projection is for global crypto exchange-traded products, or ETPs. The forecast here is for them to surpass $400 billion in assets under management by the end of 2026. Now, if that happens, it would position the entire crypto ETP complex to rival the size of the Nasdaq 100 ETF. What you're seeing on this chart is a projected nearly threefold increase in assets. This growth is really being driven by a flywheel effect of increasing liquidity and access, and yet institutional penetration is still remarkably early. Filings show that institutions hold only about 27% of Bitcoin ETP shares. That highlights a pretty significant runway for future growth as more allocators come into the space. Now, the second critical piece of infrastructure is stablecoins. The total supply is projected to reach $1 trillion, and they're evolving far beyond their initial use case as just a trading instrument. And this chart really illustrates that evolution. Stablecoins are fast becoming core payment infrastructure. They're being adopted by giants like Visa and Mastercard for settlement. And they're being driven by regulatory clarity, like Europe's MiCA framework. They are the connective tissue between traditional finance and this new on-chain economy. All right, so beyond the infrastructure, we're seeing tremendous value creation happening in the on-chain economy itself. This is really where that new financial layer becomes truly productive. Decentralized finance, or DeFi, it's forecast to more than double, exceeding $300 billion in total value locked. And this isn't just speculative capital we're talking about, it's the beginning of a fundamental shift in how capital markets actually operate. This growth is really being fueled by two key trends. First, you've got corporate treasuries that are beginning to deploy idle digital assets into DeFi protocols to generate yield. And second, as government bond yields fall, you're going to see both retail and institutional users look more and more to DeFi in their search for higher returns. The second component here is the tokenization of real-world assets, or RWAs. This market is projected to grow from roughly $35 billion today to exceed $500 billion by 2026, a massive jump. So, tokenization. It basically converts illiquid assets into these programmable, efficient, and globally accessible instruments. As this chart suggests, that growth is going to be led by private credit and the migration of private and public equity, which happen to be two of the largest untapped capital pools being brought on-chain. Now, this phase of rapid growth also introduces significant risk, specifically around market consolidation in key sectors. So for investors, identifying the long-term survivors is absolutely paramount. The Ethereum Layer 2 ecosystem is a perfect example of this. After a period of, well, proliferation, the market is now consolidating heavily. As you can see, nearly 90% of all transactions are now processed by just 3 networks: Base, Arbitrum, and Optimism. What does this mean for investors? Well, it means a flight to quality is already underway. The likely winners are going to be those with strong Ethereum alignment, major exchange backing like Coinbase's Base, or a specialized high-performance niche. On the other hand, those generalized, unprofitable rollups with low usage, they face an existential threat. Distinguishing between these two camps is absolutely critical. And you see a similar dynamic at play with digital asset treasury firms. While the whole sector is projected to grow to $250 billion, the market simply won't support all the players. Not all of them will have the capital structure, the buying strategy, or the narrative strength to survive the inevitable market downturns. Consolidation is coming. So let's bring this all together. What are the strategic implications for your portfolio as we head into 2026? How do you actually position for this new market regime? This new market regime really demands a much more sophisticated approach. The investment thesis has shifted from pure speculation on 4-year cycles to a focus on structural, long-term growth. And what that means is prioritizing that institutional-grade infrastructure, identifying the winners in these consolidating sectors, and positioning for the growth of a productive, on-chain economy. And that concludes this briefing. The core takeaway from the 21 Shares report is this: the era of simple cyclical trades is over. It's been replaced by a more complex, but ultimately more sustainable phase of structural growth. So the question for every investor now is the one right there on your screen.